Hi, I'm Katherine Chiglinsky. I'm glad to be back, and I'm very honored this time to introduce Maria Vullo. She was the former head regulator of the New York Department of Financial Services, and now she helps with the FinTech Innovation Lab in New York as a regulator advisor. And she's, obviously had a storied career and has worked with this industry for a long time. I would love to maybe kick things off with one of her big pushes when she was regulator, and that was the cybersecurity. I was wondering if you could talk a little bit about the background of that. How did it come together? Sort of how did you guys think about kind of designing one?
Sure, and good morning. It's wonderful to be here. So when I arrived at DFS in early 2016, cybersecurity was obviously a big threat to not only to our country, but certainly to the financial services industry. And I regulated the banks and the insurance companies. And there were a lot of people talking about cybersecurity, and I felt that it was important to do something about it. So we drafted a regulation. It went through, thorough comment periods, and then I finalized a regulation that mandates certain minimum standards for banks and insurance companies that are regulated in New York to follow. And that regulation, because of the way we drafted it, it's founded on a risk assessment and a lot of the other things. It's not, prescriptive in terms of what types of products you should use or how you should do it, but you need to do things like multi-factor authentication and other things. And it's become somewhat of a national model. And in the insurance industry, the National Association of Insurance Commissioners, at my urging, actually adopted that as a model law. So I think we're on a good road in the insurance industry to protect the companies from cybersecurity attacks.
And I find this really interesting because cybersecurity, we were talking about this earlier, it feels like a beast that is really hard to tame, right? Like it's really hard to protect. I was wondering if you could describe a little bit about when you were drafting this regulation, what are some things that you saw companies doing or that people talked a lot about that you said, hey, as a regulator, I want to see companies sort of tackle this?
Well, the truth is that there's no program that will say for sure that you won't be a victim of a cybersecurity attack, and there's vulnerabilities, but certainly, and all of the companies have different types of products. They have different systems. Some are small, some are big, some have multiple companies that somehow connect through information systems. So I did not want to do a regulation that was a one size fits all. So that's why the foundation of it was each company needs to perform its own risk assessment and then tailor the program to that risk assessment. But we also dealt with things like incident response, recognizing that there might be circumstances where there will be an event, and sometimes those events don't actually result in a breach, but there still needs to be an incident response plan and companies being prepared because you have issues such as business interruption and, of course, consumer privacy, private data could be breached, and you need to know how to respond and who do you contact and things like that.
That makes sense.
Yeah.
So this is on the other side of cyber stuff with cyber insurance. It's sort of a newer risk to this very old industry. Could you talk a little bit about how you view companies that are wanting to write cyber insurance?
So I'm obviously a supporter of cyber insurance, but with a very significant caveat. So as a former regulator, insurance company solvency and ability to pay claims was my primary job. So cyber insurance is like catastrophe insurance to some extent, and so the underwriting of it has to be very carefully done by the insurance industry, because if there is an attack, claims have to be made. So obviously there would be deductibles and there would be high amounts. And what I really think when you combine sort of cyber regulation and cyber insurance together is that the insurance industry really has a great opportunity in industries beyond financial services to provide for protections of industries by requiring mitigation measures in their cyber insurance policies. To me, it's no different than a good driver discount. An insurance company for cyber insurance can require the company that it's underwriting to do certain things to mitigate the risk, get a better product, get a better price, and obviously strengthen companies beyond financial services by doing so. So I'm a big fan of it with that context.
That's interesting. So you almost see like cyber insurance better when it's used as, not just the pure insurance policy, but also sort of the protection around it?
Sure. The insurance industry in many products promotes good behavior. And in cyber insurance, they can promote good behavior by requiring as part of the policy certain things that the company that's being underwritten has to do. You have to do a risk assessment. You have to have an incident response. You have to do multi-factor authentication. You need to do training for your employees. So important, since most attacks are internally, the victims become, the internal people that just make a mistake. So in insurance companies and underwriting, it could actually require those things and thereby strengthen many, many industries that they underwrite that are not themselves regulated industries where there would be a regulator that says you have to do the following things.
That makes a ton of sense.
Yeah.
So when we were talking about cyber security, you mentioned data, and
Yes.
Matt even pointed out earlier that the data that companies, insurers are using is more widespread now. I was wondering if you could talk a bit about when you were regulator, you worked with auto insurers and said that using education and occupation status, you really had to justify the risk reason you were using it, or else you couldn't.
Right.
And I was wondering if you could explain a bit. How
Sure.
did you come to that conclusion?
Sure. So data, or just what factors are considered when you decide whether to give somebody a policy and at what price. And so in the auto industry, we discovered that education and occupation were used as part of underwriting, which effectively meant that if you had a lower education, so a high school graduate was charged more for auto insurance than a PhD, and we concluded that even though there was some actuarial correlation, it wasn't strong enough, and the rationale didn't make sense that just because somebody had a high school degree, they somehow were going to be a worse driver than somebody with a PhD. I mean, I think we could all think about people in both categories and say, well, that doesn't really say much about their driving. Same thing with occupation, and often occupation is also tied to education, and that's what we found. So that was really the use of certain factors, less data like the big data that's being used in lots of other algorithmic underwriting models.
That makes sense.
Yeah.
Well, in a similar vein, I know a lot of you guys are P&C focused, but I found it really intriguing what you did with the life insurance industry when you talked about their ability to use stuff like social media or the internet to also underwrite. I was wondering, could you give us some perspective on, when you're a regulator, when you sit there, how do you decide, hey, this new source of data that's, still relatively kind of young might be good or might not be useful for companies in a consumer-friendly way?
Right, exactly. So there are two aspects. One is the financial health of the company, and the other is the consumer protection. And on both of those aspects, data has to be both reliable for its intended purpose, and it needs to be not discriminatory vis-a-vis consumers. So in the life insurance example, life insurance is underwritten in large part based upon health and health risk. And the traditional way of doing it is you get doctor reports, and then you get a blood test, and you get a urine sample. That takes a long time. And there are insurers that are seeking to basically have other proxy, data as a proxy for that type of information. And social media, we discovered, was some of that, as well as other things. And so we put out a guidance on this and basically said you need to abide by anti-discrimination laws. So you can't use data that's, for example, geographically driven, because that could violate laws precluding discrimination, persons of national origin, race, and the like. And so that was how we came at it. And also the data needs to be reliable, right? And why is social media reliable for underwriting at a certain price a life insurance policy? I think I question. We need more information. We probably need more data to correlate it somehow, because I'm not really sure that it gets there at this moment in time.
That makes sense.
Yeah.
Talking about, this is sort of related to the data trend, but the growth of telematics. I mean, obviously that gives you like a good sort of insight into the consumer and who you're working with. Could you talk a bit about how you've seen companies use telematics, and then how do regulators sort of look at, I get there's often this fear of it's a bit big brother, right? If you can track people and know where they are. Could you talk about how regulators sort of do that?
Sure. So, I mean, certainly if the consumer prefers it, telematics is a great innovation. I mean, when you're taking car insurance, for example, there may be somebody who doesn't drive the car that often, and they're saying, why am I paying this? I'm not driving that often. It's like usage-based insurance, right? UBI and telematics can be used to more accurately price that product for the consumer. Telematics can be used in a whole bunch of other areas. I mean, the sort of the Ubers and the Lyfts and the Vias and everything else, we had to, in New York, address insurance in that context, which is based in part on technology. When the car is being used for commercial purposes, then it triggers a commercial insurance policy to protect, the person who's in that car for commercial purposes, as opposed to the personal use by the driver, maybe his own car, which would be covered by a different policy. So I think in this area, telematics has some great promise and certainly is being used a fair amount. Like right now, doesn't have necessarily as difficult issues as big data, like social media and all of that, being used for underwriting purposes in the first instance.
And so why do you think it doesn't have as big?
Well, I mean, it depends upon what kind of telematics is being used, and it obviously has a privacy component to it that people feel like they're being followed. But if it's being used, again, from the regulator's point of view, if it's being used to more accurately determine the usage or what the consumer is doing, that would be real, that's where car insurance is the easiest example for that. It makes some sense to price the policy based upon usage, and everybody knows that the odometers are not the best of that because they can be phonied with. But so there's definitely, but again, when some kinds of when technology or the ability to follow people it gets more aggressive, that's when you'll have the privacy and the consumer advocates and the regulators have some concerns, and certainly telematics has some of those concerns as well.
Great. Well, you sort of touched on one of my next favorite points. With Lyft and Uber going public, obviously, if you look in those financial documents, insurance is a big part of it. And I was wondering if you could talk about, you mentioned sort of how the policies now work with those companies, but I was wondering if you could give us background on how that came to be. I mean, what is sort of the interplay between, startups who have what they consider a very cool idea and regulators who obviously need to make sure, things are being protected in the way.
Right. So, I mean, for people in New York and certainly New York City, there was the big debate between the medallion taxi industry and these ride-sharing companies that actually required legislation from the New York State legislature. And as the legislature was working through that, insurance was a very key issue that a number of people, including my department, felt was important because you needed to protect the riders in these cars. And since the ride-sharing drivers likely use their own personal cars, personal automobile insurance would not cover when you're using it for commercial purposes, so you needed a different commercial policy. And the companies themselves, the Ubers, the Lyfts, and all of them were not necessarily writing the full policy for everybody who might use it, and obviously you wanted to open this up to people for job potential. So there was the statute required a minimum level of insurance because we wanted to protect the people in those cars in the event of an accident, and that was obviously an important policy goal. And then we at the Department of Financial Services, as well as the Department of Motor Vehicles, we had to write extensive regulations to address this. And it was a usage-based insurance, so that you basically turn it on and turn it off.
Yep.
And so when it's turned on for the commercial purposes, the insurance kicks in, and when it's turned off, then it's a personal vehicle, and that driver has to have personal insurance that the company shouldn't have to have anything to do with.
Yep.
But I think, look, if you're going to be driving for the public, you need to have insurance in the event of an accident, just like the taxi drivers or anybody else would have.
That makes sense. And I find this interesting because it feels like one of the examples in which, the startups come to the market and regulators, and they have to sort of explain to each other how both sort of sides of the equation work. What were some of your key takeaways for people who are, saying, hey, I have an innovative thing and I want, sort of regulatory approval? What are some of your key takeaways from that example of what people could be doing?
Right. So, well, first of all, I think if any company that wants to be in the insurance business itself, so if you want to underwrite insurance and you're a technology company, you'd need to have a license to be an insurance company, whether it's technology driven or the traditional method of insurance. And we certainly had companies that came to us that were in that, and that takes a while. If you want to be an insurance company, you have to be able to have financial backing. You need to be able to post reserves to pay claims. You need to show that you have a good business plan. You need to obviously, protect consumers, and your product has to comply with the law. The technology itself doesn't actually change the law. And so, for example, I licensed Lemonade, which was one of the PC, total digital company in renters insurance, and that was consistent with existing law. So that, there's ways to do that. If you're a insurtech company that just has a technology product that you want to partner with an insurance company on your product, then and which is the work that I'm doing in the FinTech lab right now, which is educating the FinTechs on regulatory requirements, because if you want to sell your product or have your product be utilized by a regulated company, it's important to understand how a regulated company thinks, because it is regulated and the regulatory requirements. So I would just say engage, learn, go out, reach out to regulators, reach out and learn about the landscape. But it's certainly, I think, people are very open-minded about making it work, because the promise of technology is pretty obvious.
That makes sense. Now, this question is a little more targeted to your New York role, because whenever we talk about insurance industry, regulation is considered sometimes a barrier to entry for a lot of competitors. It's often cited as to why Amazon is maybe not fully entering it like an insurance company. And New York has a bit of a reputation as a tough regulator. So I was wondering if you could talk about your view that, according to some, that maybe, regulation is really strict and could in some ways be hurting innovation. I mean, how do you respond to that?
Regulation should be strict. My view has not changed by being out of the job. Regulation should be strict. And the reason for that is that insurance, people trigger insurance. It's usually a bad event, right? Most people don't like insurance, because something bad has happened for you to utilize your insurance. And it is critically important that the companies that write these contracts for the consumer have the money such that when the claim is made, that they actually pay on the legitimate claims. And so being regulated because of the importance of that contract to society is critically important. Insurance has been regulated since Benjamin Franklin discovered insurance back when with a fire in Philadelphia, back in the 18th century. So it's very important, and I've always been proud as a born and bred New Yorker, and certainly as the regulator in New York for 3 years, that New York is tough on this, and the proof of that is that we don't have many companies going insolvent in New York, and that's a good thing. And also, if you can get through New York, then you can get your product probably through insurance departments across the country as well. Not always, but certainly that's a hurdle to start with, and it's a good one because it's a state-by-state regulatory regime.
That makes sense.
Yeah,
so now on to your new role
Yep.
as with the FinTech Lab. I'm kind of curious. I'd be interested to hear what you think, what is sort of the biggest advice that you're giving to them? I mean, what's the one thing you're repeating to them over and over again?
So, the company, so FinTech is just financial technology. Obviously, some of them are InsurTech or Reg Tech, whatever you want to call it. But they are trying to, most of the companies that I'm dealing with are really trying to sell their products that could be very useful to insurance companies. So most of what I'm doing is educating them on regulation. And again, it's really two main buckets of things. One is insurance companies need to be fiscally sound, and they need to make sure that underwriting is done reliably. So if you have data, an insurance company, a product that's based on data, the insurance company is going to want to know that what the data is comprised of and how your algorithm works for purposes of accuracy and reliability of what it's being used for, particularly if it's underwriting. Because if they get it wrong, they're paying claims more than what they had reserved for, and that could be a financial hit to them. So that's of great concern. And the second is obviously consumer protection. So a number of the data-driven companies I'm talking to about where does the data come from, and can someone argue that that data comes from a source that is based in some type of discriminatory accessibility of that information. And so, and that would be discriminatory based on race, color, creed, national origin, sexual orientation, income, things like that that are traditional things that should not be utilized, certainly not in New York. So that's like the general principles, but there are very unique situations as well, and it's fascinating. There's a lot of great products out there.
That's great. So when I was talking with Assurance Kohlberg, he brought up this interesting point about channel conflict, right? It can be pretty hard when you have an agency force and when you're also digital. And I was curious from the regulatory perspective. When you look at the two different types of distribution, whether it's direct to consumer or through an agent, how do you sort of see the regulatory risks of both sets? I mean, is one greater than the other, or are they about similar?
So as a regulator and one who, puts consumer protection at the forefront, which, most regulators, and certainly in New York, is the case, the direct-to-consumer is, a positive model to the extent that, the consumer is getting questions answered appropriately, and to the extent disclosures are accurate. And also direct-to-consumer probably means more efficient underwriting. The digital aspect has its own benefits and risks, and again, it has to do with whether or not the digitized information is accurate, reliable, and non-discriminatory. And if it is, then it's definitely an innovation that certainly gets to direct to the consumer. The agency model is a way of also being direct to the consumer through an agent. And again, the agents are people that the regulator regulates. I mean, agents had to be licensed as well in New York, and you want to make sure that they are communicating accurate information to the consumer. And one of the biggest issues, of course, is the agent gets a commission, and you want to make sure that the agent is giving the full disclosures and taking the consumer's best interest in mind when marketing a product, and not simply because there's a commission attached to it and therefore, cutting the corners a little bit on that. But so both of them have their positives and negatives, but certainly direct to the consumer, I think, it's disruptive. It's certainly disruptive to the agency model, but it could also really reach more people more quickly, and even perhaps give the consumer greater power in the transaction that the consumer is entitled to have.
That makes sense. So maybe let's take it a little broad as we start to wrap up. What is the biggest risk that you think the insurance industry is underestimating?
Underestimating?
Yes.
I don't know about underestimating, but cybersecurity is the biggest risk that we're all facing, and certainly in the insurance industry. I think that, the traditional insurance industry needs to move ahead on technology. And I think that they recognize the need to move ahead on technology, but there are certain ways that the industry does things that makes it, more difficult for them to jump very quickly, and technology is obviously moving faster than all of us. But I think both sides really have to understand the other better, and I think because I don't think the industry or regulators are resisting technology. There's just certain ways that things are done and need to sort of get to the place together. So I think communication and interaction is the best way to foster that.
That makes sense.
Yeah.
So now we're going to end with a game of overrated or underrated.
Okay.
So I'm going to say a term, and you're going to say whether you think it's overrated or underrated. So we'll start off with the first one. RegTech.
RegTech?
Yeah.
If it means regulators taking on technology, then it's overrated, because it's going to take a long time for government to have the capital to have better technology. Okay. If that's what you mean by RegTech.
That's perfect. Mm-hmm. So next one, title insurance agents.
Totally overrated and unnecessary.
Okay. Bank cybersecurity.
Title insurance is unnecessary.
Okay.
Government should take over title insurance. That's my view. Next.
Oh, we'll have to have another panel on that.
Yeah, it's another panel.
Bank cybersecurity.
Bank cybersecurity. I think it's where it should be. I think the banks are taking it very seriously.
Great. State-by-state insurance regulation.
Oh man, overrated or underrated? Underrated. It's a great system.
Good. No bias. We're gonna. And then we'll end with FinTech charters.
FinTech charters for the OCC, completely overrated and unnecessary. And by the way, the court agreed with me on that.
Awesome.
So there.
Well, thank you so much. Round of applause for Maria Vullo
Thank
for
you.
insights
Great to
on
be here.
regulation.